fictitious capital. Okay, here we are. Hello, everyone. Weekly Marx, 3 o'clock-ish, 14 September. Today we're going to look at fictitious capital, where there's a kind of subtle distinction between interest-bearing capital and loanable money capital. I know that's may not seem like much to you, but it's an area that wasn't fully explored, although Marx knew about it. He just didn't spend a lot of time, or at least we've lost the manuscripts for it. So some of the, and like we do in Weekly Marx, we're going to look at a little of Marx's own writing on it, which is actually, we're skipping ahead to volume 3, where he does discuss fictional capital. But you'll note, of course, that in Marx's, even the version that's provided in volume 3, some of it is filled in by Engels. So some, and remember, these are all kind of fragmentary. Marx just took a lot of notes. Often he was copying from the official commentaries or other kinds of government documents. This was while he was spending time in the British Museum, the British Library. So much of this is fragmentary, but there's a tremendous literature, actually somewhat recent literature. So there's some new literature on this, which I unfortunately have to start reading. So we have a couple of front-end elements about it. So first thing, fictitious capital. It's 2018, but likely really a much earlier document by Suzanne de Bruynhoff, who was one of the few people in the post-war period to actually concentrate on Marx's concepts of money. And this was before, modern money theory, et cetera, et cetera. She was one of the few actual experts before modern money theory sort of took off. The concept, this is from an abstract or the section from the New Palgrave Dictionary of Economics by Suzanne de Bruynhoff. Chosen, of course, because she had that position in the field. The concept of fictitious capital is rarely used by economists today. According to the rather small, though diverse group of authors who have used the notion, it refers to the finance of productive activity by means of credit. Let me stop for a second and say, this is what we've been looking at for this past week, is various versions of the debt credit problem. Michael Hudson being, in terms of modern money theory and a variety of other things, pointing out the kind of important nature of this. Some of which, as we were discussing yesterday about compound interest, it has fictitious elements in it because, you're obviously creating value without corresponding labor. But the question, of course, is, you're not having corresponding labor, but you are having corresponding labor power, which is, I think, where the crux of the problem is relative to people like Heinrich, et cetera. So I hope you can follow that. So back to de Bruynhoff. Whatever their differences, all authors contrast fictitious capital with real capital, where the latter usually refers to produced means of production, but may also include what Marxists call money capital. This is the money capital idea, of course, is what MMT is trying to focus on. It's quite palpable and can be used in very powerful ways. In terms of Jubilee or whatever, that it's actually quite powerful in that context. One group of authors contrasts finance by means of fictitious capital with voluntary, i.e., not forced, savings of the means of production. So here we have some idea about the concept of saving. And in fact, that's a worthy topic relative to the Marxist literature, is the concept of saving. But anyway, that's another story. Hayek, 1939, often followed by a significant number of right-wing folks, is a member of this group and refers to Weiner's, says Jakob Weiner, 1937, brief discussion of the use of the concept by English economists, for example, by Lauderdale and Ricardo, David Ricardo. On the other hand, Marx and Rudolf Hilferding, analyzed the concept of fictitious capital with respect to different forms of borrowed capital and to the significance of the market value of financial titles and their relation to the value produced by labor. So financial titles meaning certain property forms, and that's another discussion as well. So fictitious capital is a text that is by Akim Sapansky and is part of a book series on Marx, Engels, and Marxisms. It's 2022. I don't have a copy of this probably yet, although at some moment. There is, as I've included here, a copy of the front end, that is the first 30 pages of it, which we may look at this week in a PDF. So there's that link as well. This is the abstract for it. According to Marx, fictitious capital is shares and bonds of corporations and states, whose buying includes the legal right for participation in future flows of income in the form of interest or dividends. So already it's all abstract stuff. Fictitious capital is the claim on a future sum of money, which should be realized as a future increase of money capital. So it's always this thing that is profitable in the future. Low interest rates will lead to a rise in the price of securities. That's hopefully obvious. Interest rates and the prices of securities act inverse to each other. The trend to negative interest, that is lower interest rates, mean higher security values. The trend to negative interest rates will lead to a rise in shares, bonds, and real estate prices. This is that whole debt thing. That's why Trump is the king of debt. Simultaneously, low-income parts of the population hold their savings at bank accounts and suffer from negative interest rates. The rich, of course, benefit when they hold their assets as shares, real estate, or bonds, which is why, the poor try to get those kinds of things. The price of a security depends not only on approval between buyer and seller, but on also other economic factors like business cycles, interest rates, and differential capital accumulation movements influencing the prices. So you have this entire system there that's working, at both for good and for evil. And we've seen in our class unity course the interest taken in manipulating these kinds of things. David Harvey, uses the term capitalization, which is the formal process of building fictitious capital. Harvey builds an entire model around this because it works for his general model about space and time and, capitalism and infrastructure and, globalization, all that other stuff. Unique income flows, which result from assets like bonds, shares, or real estate, are allocated to fictitious capital, whose fixing is dependent, besides the expectations of buyers and sellers on future income, which you just talked about, it's dependent on interest rates, which are the result of the game of supply and demand at the money and capital markets and have an effect, again, on the expectations. Now, note that this commentary means that focusing on the interest rates is not focusing on the thing itself. It is, in fact, focusing on some other kinds of elements that are a fraction or a multiple of the thing. The risk, whether money proves itself in the future as money capital, is now integrated directly into the asset. However, like the credit, the asset involves for a fixed period of time a double increase of capital. Recall that when we were talking about compound interest, that there's a kind of doubling effect that occurs. The buying of an asset includes the particular use of the use value of fictitious capital to create profit in the future. So fictitious capital having a use value is a kind of funny thing because it's, it doesn't quite exist, yet it has a use value. So this is an interesting question. It has an abstract relation. At the same time, the seller of a bond or a share is not separated from the capitalization of money capital because the issuer of bonds or shares, like the government or banks or whatever, owes the money he got by selling the asset and which he can now use to organize profit-driven production process. So there is a connection to production. It's just one that is, you could call it articulation. That's not a good word for it. Probably mediation might work a little better. So that's kind of what we're looking at here. We're looking at various abstract production of value, and that is not ephemeral. It's not epiphenomenal. It's there. It's always been there. It's been there since usury. So we should not go to the point of saying, well, it's just all, vapor. It's not. Companies borrow from private banks in the short term to secure their cash flows, or they take out longer-term loans to finance their investments. They issue bonds or shares on financial markets to raise money from investors, and they use derivatives to hedge against adverse movements in interest rates that limit their profitability. This is the history of modern post-1980 capitalism. So these are important ideas, and this is from another conversation of the that is also a fraction of what we should be looking at. Nevertheless, this is from a footnote 6. Nevertheless, Marx developed the financial system only rudimentarily as the controlling instance of capitalist accumulation. Recall that the whole business of Marx talking about this stuff is accumulating capital, whether it was primitive or whether it's accumulation under capitalism, where it's extremely important and problematic. Although Marx was fully aware of the following facts in the Grundrisse. So the point is that Capital Volume 3 as a later text is still, sort of implied or echoed in from the Grundrisse, which is, the word Grundrisse means foundation. It is a foundational text in that context, even though no one read it for almost a century. In the money market, this is from the Grundrisse, in the money market, capital is posited in its totality. There it determines price, provides work, regulates production, and in a word, source of production. So you can see that this connection just used above is the idea that it's not simply, post-production or a part of circulation. It is circulated, of course, but it has a clear connection to production. It's not, sort of that discrete. So on to Marx himself. Capital Volume 3, Part 5, Division of Profit into Interest and Profit of Enterprises. Interest-bearing capital. So this is Marx's words, and I'll indicate subsequently whether it's a section written by Engels. And as I said, I've taken out a lot of this because much of it is quotations from official documents on the commentary of how this capital stuff operates. What Marx is doing in this case is to identify these things that aren't quite palpable, that is, that are fictitious, how they operate. They operate because of things like time and space, the things that David Harvey is talking about, the elements of circulation. And to give you the brief historical model of this, Marx is there and, he's thinking about colonialism and all this other stuff, exploitation stuff that's going on. The reality of it, as we looked at in Brad DeLong's work, is the fact that while you have all this actual stuff going on, trade, production, manufacturing, etc., some of it is being mediated, as Marx has indicated, in the season. That is, the telegraph becomes, or elements or means of communication become actually really important. And in fact, they mobilize the idea of a fictitious capital, and hence from that, modify interest-bearing capital because of it. So you have people on telegraph things, ... dash, blah, 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 sending stuff thousands of miles, and there's the gap between the getting the actual stuff and the ordering or decision making is differentiated, and in fact, that distancing, time and space, and other stuff is seems ephemeral, but it's not really ephemeral or epiphenomenal. It's there. It's substantive. You have commands or orders and money and ticker tape and stuff, telegrams, and that's still palpable. Okay, chapter 25, credit and fictitious capital. Exhaustive analysis of the credit system and of the instruments which it creates for its own use, that is credit, money, etc., lies beyond our plan. That's the big picture. We merely wish, Marx is writing here, to dwell upon a few particular points which are required to characterize the capitalist mode of production in general. We shall deal only with commercial and bank credit. The connection between the development of this form of credit and that of public credit will not be considered here. So this is the difference. He's talking about private stuff and not how the state operates. I've shown earlier, that is earlier in Capital 3, how the function of money as a means of payment and therewith a relation of creditor and debtor between the producer and trader of commodities develop from the simple circulation of commodities. With the development of commerce and of the capitalist mode of production, which produces solely with an eye to circulation, this natural basis of the credit system is extended, generalized, and worked out. Money serves here, by and large, merely as a means of payment. That is, commodities are not sold for money, but for a written promise to pay for them at a certain date. For brevity's sake, we may put all these promissory notes under the general head of bills of exchange. Such bills of exchange, in their turn, circulate as means of payment until the day on which they fall due, and they form the actual commercial money. Inasmuch as they ultimately neutralize one another through the balancing of claims and debts, they act absolutely as money, although there is no eventual transformation into actual money. So you can already see what's going on here, I hope. Just as these mutual advances of producers and merchants make up the real foundation of credit, so does the instrument of their circulation, that is, the bill of exchange, form the basis of credit money proper, of banknotes, etc. These do not rest upon the circulation of money, be it metallic or government-issued paper money, but rather on the circulation of bills of exchange. So already Marx is talking about the concept of a certain type of abstraction, no different, I would assert, than the concept of abstract labor. So we skip forward after he's done quoting a bunch of different, things. On the other side of the credit system is connected with the development of money dealing, which of course keeps step under capitalist production with the development of dealing in commodity. We have seen in the preceding part, that is chapter 19, we're in chapter 25 right now, how the care of the reserve funds of businessmen, the technical operations of receiving and dispersing money, of international payments, and thus of the bullion trade, that is gold trade, are concentrated in the hands of the money dealers. The other side of the credit system, the management of interest-bearing capital or money capital, and note that at the start of this, I just made this distinction between money-bearing capital and money capital itself, develops alongside this money dealing as a special function of the money dealers. Borrowing and lending money becomes their particular business. They act as middlemen between the actual lender and the borrower of money capital. Generally speaking, this aspect of the banking business consists of concentrating large amounts of the loanable money capital, the LMC, not necessarily identical to interest-bearing capital, loanable money capital in the banker's hands, so that in place of the individual money lender, the bankers confront the industrial capitalists and commercial capitalists as representative of all money lenders. They become the general managers of money capital. On the other hand, by borrowing for the entire world of commerce, they concentrate all the borrowers vis-a-vis all the lenders. A bank represents a centralization of money capital of the lenders on the one hand, and on the other, a centralization of the borrowers. So that's what banks represent. Its profit is generally made by borrowing at a lower rate of interest than it receives in loaning. Fairly obvious. The loanable capital which the banks have at their disposal streams to them in various ways. In the first place, being the cashiers of the industrial capitalists, all the money capital which every producer and merchant must have as a reserve fund or receives in payment is concentrated in their hands. These funds are thus converted into loanable money capital. In this way, the reserve fund of the commercial world, because it's concentrated in a common treasury, is reduced to its necessary minimum, and a portion of the money capital, which would otherwise have to lie slumbering as a reserve fund, is loaned out and serves as interest-bearing capital. In the second place, the loanable capital of the banks is formed by the deposits of money capitals who entrust them with the business of loaning them out. So there is a kind of money bin effect, but it's not just sitting there, it's moving around. Furthermore, with the development of the banking system, and particularly as soon as banks came to pay interest on deposits, money savings and the temporarily idle money of all classes were deposited with them. Small amounts, each in itself incapable of acting in the capacity of money capital, merge together into large masses and thus form a money power. Note that this concept of a money power, not that different than the idea of a labor power. This aggregation of small amounts must be distinguished as a specific function of the banking system from its go-between activities between money capitalists proper and those who are borrowing, the borrowers. In the final analysis, the revenues, which are usually but gradually consumed, are also deposited in the banks. So they're kind of keeping an eye on everything. The loan is made, we refer here strictly to commercial credit, by discounting bills of exchange, that is, by converting bills of exchange into money before they come due, and by advances of various kind, that is, direct advances on personal credit, loans against securities such as interest-bearing paper, government paper, stocks of all sorts, and notably overdrafts against bills of lading, dock warrants, and other certified titles of ownership of commodities and overdrawing deposits, etc. So you can see that there's all these different levels of how money gets transferred. And note that at every step you have, conversions of one kind or another, or transmission of one kind or another of financial information. The credit given by a banker may assume various forms, such as bills of exchange on other banks, checks on them, that is, writing a check on them, credit accounts of the same kind, and finally, if the bank is entitled to issue notes, this is an important thing, banknotes of the bank itself. So the bank is issuing its own kind of currency or demand, as it were. A banknote is nothing but a draft upon a banker, payable at any time to the bearer, and given by the banker in place of private drafts. This last form of credit appears particularly important and striking to the layman. First, because this form of credit money breaks out of the confines of mere commercial circulation into general circulation and serves there as money. And because in most countries, the principal banks issuing notes, being a peculiar mixture of national and private banks, actually have the national credit to back them, and their notes are more or less legal tender, because it is apparent here that the banker deals in credit itself, a banknote being merely a circulating token of credit. Okay, so this is this idea that, there is something palpable there, but, banknotes are just simply another, paper-like record, but it has certain exchange value, let's put it that way. Yeah, well, that may not be the best use of the word. But the banker also has to do with credit in all its other forms, even when he advances the cash money deposited with him. In fact, a banknote simply represents the coin of wholesale trade as opposed to retail trade. And it is always the deposit which carries the most weight with banks. You have to have stuff in there. The best proof of this is furnished by the Scottish banks. And then he does a thing here on Scottish banks, giving rise to that, Scrooge McDuck thing. Now, there's a section here, and this section is, I think, given to us by Engels. This is all written by Engels, so assume a different voice here, and Engels is trying to fill out some of the elements of this part of Volume 3, Chapter 25. We've seen that Gilbert knew that even in 1834, that whatever gives facilities to trade gives facilities to speculation. Trade and speculation are in some cases so nearly allied that it is impossible to say at what precise point trade ends and speculation begins. The easier it is to obtain advances on unsold commodities, the more such advances are taken, and the greater the temptation to manufacture commodities or dump already manufactured commodities in distant markets just to obtain advances of money on them. So you can see there's already, this is what Mitt Romney was claiming about currency manipulation and dumping. To what extent the entire business world of a country may be seized by such swindling, and what it finally comes to, is amply illustrated by the history of English business during 1845 to 47. It shows us what credit can accomplish. Now, before passing on to the following examples, a few preliminary remarks. And note that a majority of this chapter is actually a lot of discussion from financial entities, which I haven't included here. At the close of 1842, the pressure which English industry suffered almost interruptedly since 1837 began to lift. During the following 2 years, foreign demand for English manufactured goods increased still more. 1845 and 1846 marked a period of greatest prosperity. In 1843, the Opium War had opened China to English commerce. That's for another story. The new market gave a new impetus to the further expansion of an expanding industry, particularly the cotton industry. How can we ever produce too much? We have to clothe 300 million people, a Manchester manufacturer said to this writer at the time. But all the newly erected factory buildings, steam engines, and spinning and weaving machines did not suffice to absorb the surplus value pouring in from Lancashire. With the same zeal as was shown in expanding production, people engaged in building railways. The thirst for speculation of manufacturers and merchants at first found gratification in this field, and as early as the summer of 1844, stock, that is railway stock, I think, was fully underwritten, i.e. so far as there was money to cover the initial payments. As for the rest, time would show, but when further payments were due, et cetera, indicates that the capital investment in railways in 1846 to 47 amounted to 75 million pounds. Recourse had to be taken to credit, and in most cases, the basic enterprises of the firm had also to bleed. This is still Engels talking. And in most cases, these basic enterprises were already overburdened. The exceedingly high profits had led to far more extensive operations than justified by the available liquid resources. You have a liquidity crisis here. Yet there was credit easy to obtain and cheap. The bank discount rate stood low, that is 1 3/4 to 2 3/4% in 1844, less than 3% until October 1845, rising to 5% for a while, February 1846, and dropping again to 3 1/4% in December 1846. The Bank of England had an unheard of supply of gold in its vaults. All inland quotations were higher than ever before. Why then allow this splendid opportunity to escape? Why not go all in? Go in for all one was worth. Why not send all one could manufacture to foreign markets which pined for English goods? And why should not the manufacturer himself pocket the double gain? Remember, we're talking about compound interest. Double gain arising from selling yarn and fabrics in the Far East and the return cargo in England. Thus arose the system of mass consignments to India and China against advance payments, and this soon developed into a system of consignments purely for the sake of getting advances, as described in greater detail in the following notes, which led inevitably to overflooding the markets and a crash. The crash was precipitated by the crop failure of 1846. Remember, there's a corn law, sort of that has been there before. England, and particularly Ireland, required enormous imports of foodstuffs, notably corn and potatoes. But the countries which supplied them could be paid with the products of English industry only to a very limited extent. Precious metals had to be given out. Gold worth at least 9 million was sent abroad. Of this amount, no less than 7.5 million came from the Treasury of the Bank of England, whose freedom of action on the money market was thereby considerably impaired. Other banks whose reserves were deposited with the Bank of England and were practically identical to those of the bank were thus also compelled to curtail a combination of money. The rapid and easy flow of payments was obstructed first here and there, and then generally. The banking discount rate, still 3 to 3.5% in January 1847, rose to 7% in April. When the first panic broke out, the situation eased somewhat in the summer, back to 6.5% and 6%. But when the new crop failed, as well, panic broke out afresh and even more violently. The official minimum bank discount rose in October to 7%, and then in November to 10%, i.e., the overwhelming mass of bills of exchange was discountable only at outrageous rates of interest, or no longer discountable at all. The general cessation of payments caused the failure of several leading and very many medium-sized and small firms. The bank itself was in danger due to the limitations imposed by the Artful Bank Act of 1844. So about, reserves in that sense. The government yielded to the general clamor and suspended the Bank Act on October 25, thereby eliminating the absurd legal fetters imposed on the bank. Now it could throw its supply of banknotes into circulation without hindrance, the credit of these banknotes being in practice guaranteed by the credit of the nation itself. And thus unimpaired, the money stringency was thus instantly and decisively relieved. Naturally, quite a number of hopelessly enmeshed large and small firms failed nevertheless. But the peak of the crisis was overcome. The banking discount dropped to 5% in December, and in the course of 1848, a new wave of business activity began, which took the edge off the revolutionary movements on the continent in 1849, and which inaugurated in the 1850s, an unprecedented industrial prosperity, but then ended again in the crash of 1857. Note that this is an important time. I mean, there's a lot of stuff going on. The British did not have revolutions. There were no revolutions going on here. I mean, there were little smaller things, Chartists, blah, 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 but nothing at the level of, overthrowing the governments in Germany and France, etc. So that's the end of Frederick Engel's comment on that. Number 2, this is Marx talking now. With reference to the swindle in East Indian trade, in which drafts were no longer drawn because commodities were being bought, but rather commodities were being brought to be able to make out discountable drafts, convertible into money. The Manchester Guardian of November 24th, 1847 remarks, now, Mr. A in London instructs a Mr. B to buy from the manufacturer C in Manchester commodities for shipment to a Mr. D in East India. B pays C in 6 months drafts to be made out by C on B. B secures himself by 6 months drafts on A. As soon as the goods are shipped, A makes out 6 months drafts on D against the mailed bill of lading. So it's fairly complicated. The shipper and consignee were thus both put in possession of funds months before they were actually paid for the goods, and very commonly these bills were renewed at maturity on pretense of affording time for the returns in a long trade. Unfortunately, losses by such a trade, instead of leading to its contraction, led directly to its increase. The poorer men became, the greater need they had to purchase in order to make up by new advances the capital they had lost on the past adventures. You can see how this accelerates. Purchases thus became not a question of supply and demand, but the most important part of the finance operations of a firm laboring under difficulties. But this is only one side of the picture. What took place in reference to the export of goods at home was taking place in the purchase and shipment of produce abroad. Houses in India who had credit to pass their bills were purchasers of sugar, indigo, silk, or cotton, not because the prices advised from London by the last overland mail promised a profit on the prices current in India, but because former drafts upon the London house would soon fall due and must be provided for. What was so simple as to purchase a cargo of sugar, pay for it in bills upon the London house at 10 months' date, transmit the shipping documents by the overland mail, and in less than 2 months, the goods on the high seas, or perhaps not yet past the mouth of the Hooghly, were pawned. We're talking about customs stuff. Were pawned in Lombard Street, putting the London house in funds 8 months before the drafts against those goods fell due. And all this went on without interruption or difficulty as long as bill brokers had abundance of money at call. So we're talking about people holding reserves to advance on bills of lading and dock warrants and to discount without limit the bills of India houses drawn upon the eminent firms in Mincing Lane. Now, Engels makes a comment here. This fraudulent procedure remained in vogue so long as goods to and from India had to round the Cape in sailing vessels. But ever since, they are being shipped in steamboats via the Suez Canal. This method of fabricating fictitious capital, finally noted, has been deprived of its basis, that is, the long freight voyage. And ever since the telegraph informs the English businessman about the Indian market and the Indian merchant about the English market on the same day, this method has become totally impractical. So here we have a comment exactly that fictitious capital and communication, high-speed communication, still as fast as, picking up a phone is pretty much the key issue of fictitious capital. And then I'll close with this thing, a quote by Charles Turner. Swindling in the East Indian and Chinese market of 1847. So Turner is head of one of the leading East Indian houses in Liverpool. Note, of course, that commenting on the East Indian and Chinese market, they're all connected together because you have transshipment going on between India and China during the period. So in other words, particularly after the Opium War, you have opium coming out of one place like India and winding up in China, but then it's a transship that is in a place like Singapore, for example. You would have exchanges for opium becomes a kind of medium of exchange in terms of value and in terms of exchanging silk and cotton, etc. So there's other kinds of things going on in transshipment in intermediate places. And of course, there's funds that are involved. Okay. Charles Turner. We're all aware of the events which have taken place as regards the Mauritius trade. This is the India trade via Mauritius is the island in the Indian Ocean, and other trades of that kind. The brokers have been in the habit not only of advancing upon goods after their arrival to meet the bills drawn against those goods, which is perfectly legitimate, and upon the bills of lading, but they've advanced upon produce before it was shipped, and in some cases before it was even manufactured. So to speak of my own individual instance, I have bought bills in Calcutta, India, to the extent of 6,000 or 7,000 pounds in one particular instance. The proceeds of the bills went down to the Mauritius to help in the growth of sugar. Those bills came to England, and above half of them were protested. For when the shipments of sugar came forward, instead of being held to pay those bills, it had been mortgaged to third parties before it was shipped. In fact, before it was even boiled. Now, manufacturers are insisting upon cash, but this does not amount to much because if a buyer has any credit in London, he can draw upon the house and get the bill discounted. He goes to London where discounts are now cheap. He gets the bill discounted and pays bill of lading discounted and pays cash to the manufacturer. It takes 12 months at least for the shipper of goods to get his return from India. A man with 10 or 15,000 pounds would go into the India trade. He could open a credit with a house in London to a considerable extent, giving that house 1%. He drawing upon the house in London on the understanding that the proceeds of the goods that go out are to be returned to the house in London, but it being perfectly understood by both parties that the man in London is to be kept out of a cash advance. That is to say, in other words, the bills are to be renewed till the proceeds come home. The bills were discounted at Liverpool, Manchester, or in London. Many of them lie in the Scotch banks. There's one house which failed in London the other day, and in examining their affairs, a transaction of this sort was proved to have taken place. There's a house of business at Manchester and another at Calcutta. They opened a credit account with the house in London to the extent of 200,000 pounds. That is to say, the friends of this house in Manchester who consigned goods to the East India House from Glasgow and from Manchester had the power of drawing upon the house in London to the extent of 200,000 pounds. And at the same time, there was an understanding that the corresponding house in Calcutta were to draw upon the London house to the extent of 200,000 pounds. With the proceeds of those bills sold in Calcutta, they were to buy other bills and remit them to the house in London. To take up the first bills drawn from Glasgow, there would have been 600,000 pounds of bills created upon that transaction. At present, if a house in Calcutta purchased a cargo for England and gave their own bills upon the correspondents in London in payment, and they send the bills of lading home to this country, those bills of lading immediately become available to them in Lombard Street for advances. And they have 8 months' use of the money before their correspondents are called upon to pay. Now, I've mentioned before about playing the float. And this is exactly, how fictitious capital can and will and does operate. And this is exactly the same issues that we see mentioned by Michael Hudson relative to the manipulation of these matters. Now, let me cite a couple of other things that are, I think, useful in this context, because Marx is, as I think you can see in reading Marx himself and Engels kind of chiming in, is how capital does all this stuff, and none of it seems to have a labor implication, although the abstraction itself uses the same structure as in commenting on the development of surplus value. So this is from an Annie Davis article of 2022 about, and it's a little bit more flighty, I suppose, fictitious capital money, the symbol and the state. In this chapter, we will review Marx's concept of money and capital as an illustration of the ways in which the meaning of a term includes the appropriate roles, norms, and actions. Actors can use money as a way to generate more money, following specific rules according to the logic of capital. We just saw that. The meaning of these terms, money and capital, only exists by the regularity of these specific actions, which then are represented by the symbol of money. When money itself is reified, it stands for the actions of those participating in the capitalist system, with implications we will explore in a case study. So that's one version of thinking about fictitious capital. Another one is from Alex Wilhan's, Antonio Piletto, and Pedro Rossi, an article called Marx's Fictitious Capital, a Misrepresented Category Revisited. So I would hope that you could appreciate that in the recent years, since since Harvey was talking about fictitious capital, and he's been talking about it for a couple decades, there's more interest in this. In this paper, this is the abstract, we provide an interpretation of Marx's category of fictitious capital by analyzing its main attributes and pointing out its role in understanding the capitalist dynamics from a value form approach. Now, here we see the introduction of the current issue that is, Marxologists are kind of fiddling with, people like Heinrich. We criticize the widespread notion that fictitious capital is a category related to the degree of detachment between its capital value and the value of the real capital that it might eventually represent. So note, there's, conflict here. We argue that fictitious capital should be defined by 3 key attributes. Number 1, the future flow of income. Number 2, the secondary market. And number 3, its real non-existence, which is obviously an oxymoronic. Fictitious capital is therefore presented as the genetic development of interest-bearing capital. Remember, I talked at the very front end about the difference between interest-bearing capital and, whatever. A process in which any expected money income is converted into a capital value in the present and transformed into a commodity. In this perspective, the importance of fictitious capital for the understanding of contemporary capitalism is analyzed, particularly with respect to the process of the distribution of social labor. See, if you talk about social labor, you're already talking about it sort of a certain abstract value. And hence, we're sort of in this value form thing. And I think we'll close with this one. It's a Let's see, where are we now? Oh, I've yacked far too much. Let me just read the front end of this. Essentially, this is about debt bondage. Um, this is fictitious capital, the credit system, and the particular case of government bonds in Marx. It's by Carolina Alvis. Um, and she holds the Joan Robinson Research Fellow, the title, the position of Joan Robinson Research Fellow in Heterodox Economics at Girton College at Cambridge. So big deal here. This paper is a theoretical contribution to the development and update of Marx's theory of money and credit, given the empirical developments in finance since the 1970s. It expands on the discussion of fictitious capital and government bonds within the Marxian literature. In contrast with most Marxian literature and some of Marx's own writings on the topic, I argue that fictitious capital does not represent any real capital. It's an important argument. And then further develop the idea that fictitious capital is the channel through which the dominance of interest-bearing capital over other forms of capital occurs. So this is an interesting way of sort of framing the argument. This interpretation lays the foundation for understanding why government bonds, as titles of fictitious capital, are the keystone of financial markets and an unavoidable source for both financial accumulation and exploitation, rather than being a mere consequence of state spending. For this reason, and this is actually the key point, public debt can neither be avoided nor fully paid off. This is actually a sub-argument for MMT, or you could use it that way anyway. So there's this can fit into the larger argument that we've been looking at relative to Michael Hudson's work, and I hope you can see that there are connections here that are we're talking about financialization. Okay, so I don't know if we want to go on further about this, but let me just stop there, and you can yak, I suppose. Are there questions or comments? What we do with all this other people's money, non-fictitious capital, cartoon money?
At some point, I'd like to look at the opium war.
Oh, it's so wonderful. It's just the war is essentially manufactured. It's the way in which the British make their intrusion into the Chinese market. That it's a made up war essentially, and then because of superior military power, that's how the Brits win the Opium War.
Yeah.
Opium, the opium is not something that the dynastic rulers of China really want there. They think it's a scourge, right? It's just that it's just it's the war on drugs. It's the same thing. It's the the war on drugs. The problem is that it has value in these transshipments that I'm talking about. That is, opium goes from India to China, but what comes from China, of course, is goods that are exchanged against the opium that's going to China and that goes, whatever, to India, et cetera, and elsewhere.
That part about the delay between because of the duration of that around the Horn ship trip.
Yes.
Reminded me of hops. They added hops to the beer to make it last that longer.
Yes. Yes, exactly. No, it's the same stuff. It's the same deal, but it creates, of course, from a Ballarat's point of view, its own market, right?
Yeah.
Hoppy lagers or whatever.
Yeah. IPAs.
Well, I mean, you could say that, the formation or creation of a lager market is that as a secondary market, or its dominance within the context of South Asia. You have more, lagers there than no one drinks stout in India and China.
Don't forget the rum.
Yeah, that reminds me of that history of the chili pepper.
Oh, yes, indeed. Indeed.
It's very interesting.
our tastes are driven by these kinds of very strange trade relations. I mean, it's a good thing, right? I mean, and spices are sort of necessary to
Yeah.
make terrible food palatable.
Yeah.
Um, and well, with respect, spices also extend the life of food, right? Because spices
Right.
force you
Yeah. Salt.
not to consume so much. Yeah, it's preservation on the one hand, but it's also constraining of consumption. It creates its own austerity. So, I mean, why else numb your tongue? I don't know.
Yeah.
I mean, it promotes sweat, and that's important for cooling in a subtropical climate. Blah blah blah. Whatever.
Yeah. I
Other.
guess oh, go ahead.
Go ahead. No. Go ahead.
Well, I was thinking about the peppers in China were seen as like ubiquitous, and so they were for the poor people.
Oh yes.
The pepper, I guess the black pepper was like super valuable, right?
Oh yeah. Well, I mean, spice in general. I think if you've had too much bland food, you really do want to, you know, encourage pleasure.
Yeah.
But they're small pleasures, but very important to those who are poor.
Yeah.
Other comments, questions? The schedule today is uh, bringing the news. We're in the bringing the news portion. Bringing the music is at 9. I think that's it. I hope people will stick around or come back and do those sorts of things, noting, of course, that we have no Valley Vox for the entire fall season, as I recall. So we'll have to make up our own stuff. I will remind you tomorrow, in place of Star Trek, which is what we've been showing or doing at 5 o'clock, I will show one time only, do a presentation including Galaxy Quest, a movie which, as I would assert, the or the or Star Trek. No, it doesn't explain all of Star Trek, but it is what I always come back to when I think of watching Star Trek. Simply because it's a kind of critique of the subsequent basic issue. I will thank you for your attention. Thank you, Larry. Lane is offering up a watching of, I assume, the original Hitchcock Psycho, which is a fun movie.
Yeah.
Be useful to watch afterwards. One of the there's a movie. What's the name of the stupid movie? It doesn't have Psycho in the title. It's a movie about Hitchcock's making of Psycho. It has to do. Some of you know this. It's a recent movie. It has the kid who is sort of wandering around the set or whatever, and sort of we see all the other, Hitchcock in the midst of making Psycho. So it has this kind of strange quasi documentary element to it. I'm sorry I can't remember the name. That's worth watching after this, after Psycho. And is it Truffaut who does something on this? Anyway, there's stuff on Hitchcock that is just great stuff. But of course, Psycho is the paradigm. I mean, it does, and then we can have all these sub arguments about the shower scene being done by Saul Bass instead of Hitchcock, et cetera, et cetera, et cetera. Anyway, for those who are cineasts, I suppose. So I'm up for watching Psycho again. It's always nice to look at it because it has you know, it has subtext built into it. You could say that Pulp Fiction has a certain a kind of is a quasi homage to it, among many other films. I mean, it is a paradigmatic film. I mean, it tells us about, you know, it reminds us of the sort of front end of film theory as a grammatical tool, and of course, the fact that you have actual graphic designers engaged with the not only the titles but the editing itself. That's also lots of fun. Sorry, I lapse into academia. Let me get us. I think if I've been given the